Well, good morning and welcome to the bank. With me I've got John McDermott, who I'm sure you all know, Chief Economist and Assistant Governor.
Governor, what bearing do you think China has had on your decision today, and what impact might another sharp yuan devaluation have on the New Zealand economy and therefore your policy decisions going forward?
I think the challenge with China is that it's building up a number of imbalances that are serious. And I don't think anyone's looking at this sort of colloquial term, hard landing. I don't think anyone's looking at that for the Chinese economy at any point in time in the foreseeable future. But it's true that their manufacturing sector and their construction and building sector is very much under stress, in essence. I mean, the rate of growth is slowing very substantially. The other thing that's been happening has been a very dramatic build-up in corporate debt in about the last 6 years. So if you look at the corporate debt to GDP ratio, it's increased by about 70% in the last 6 years. Now, that's enormous. I can't think of any other country that would have, in terms of the actual dollar build-up in debt, that we've seen anything like that. Now, a lot of it is in the state-owned enterprise sector, and I think a lot of the concern is that it's not being addressed, and partly that's, I think, because of what's happening in the other sectors, such as manufacturing and construction activity and all of that. So I think people are watching China very closely to see what policy measures it's taking. It did increase bank lending enormously in January. There was a big increase. And at the G20 meeting in Shanghai a couple of weeks ago, the Chinese made commitments about easing monetary policy and easing fiscal policy. And partly as a result of that, perhaps that's why you might have seen iron ore prices pick up very substantially. Now, you asked about a devaluation. How would it affect us? I mean, if China, I think, had a very significant and prolonged devaluation, it would, in essence, spread deflation around the world. It's so dominant in the international trading system. It's such a big, powerful economy that by and large every other currency would be appreciating against the Chinese currency. And I think that would pose particular problems for Japan, which exports a lot of its products to China. So we would be affected through the exchange rate, we'd be affected through whatever has caused the Chinese economy to slow. That would affect our trade volumes as well, and it would affect Australia.
Governor, since your speech a couple of months ago about the PTA and not reacting to the drop in commodity prices, do you think that the bank's had a bit of a change of mind, and do you think cutting today might be seen by some as joining the so-called currency war?
We gave the speech in February, partly because we were concerned that some of the commentaries that we were seeing around the PTA were slightly simplistic, to say the least. Some of them were pretty simplistic. They seemed to have a view, well, headline inflation is low, without understanding or commenting on what was happening in the rest of the world about headline inflation, or why headline inflation was low in New Zealand, and what was the actual requirements of the policy targets agreement. So the speech talked a lot about what was happening in the international economy. It talked about why inflation was low, what were the supply side forces driving it in terms of international forces, globalisation, and in essence, globalisation, technology and demography, and what were the supply side forces acting here about dairy prices and oil prices, participation and migration flows and all of that. So we wanted to explain more about why inflation was low, and it wasn't just a New Zealand phenomena. And then we looked at the PTA and what does it actually say? And so I tried to explain why certain phrases were put in the PTA. Some of them were put in explicitly by the Finance Minister and the Central Bank for this PTA, and the reasons why we did it were spelt out in that speech. And then it basically said, look, you know, what we're required to do is to monitor asset prices, and why housing prices in particular were part of that equation, and our requirements in terms of the efficiency and stability of the financial system, and our need to avoid, or our requirement to avoid, unnecessary volatility in exchange rates, output and interest rates. So it's a very complex document that comes together in a page and a half, and the speech was really trying to talk about, you know, why that the PTA was a much more complex document than what other people might be suggesting. Sorry, the second part of your question?
Do you think that some might look at this as the Reserve Bank, joining the currency war, or what some commentators are calling the currency war?
I wouldn't think so. I mean, we've been talking about risks around the international economy for quite some time. We've been talking about the fact that our exchange rate's been appreciating while our terms of trade have been dropping. You know, we're a long way away from negative interest rates that you're seeing in, you know, Denmark, Switzerland and Sweden and the European Central Bank and the Bank of Japan. We're a long way away from that. But I think it's probably fair to say that, you know, pretty well most central banks would like to see their exchange rates lower at this point. I think that would certainly be fair comment. Did you want to add anything, John?
Yeah, maybe just to emphasise the point that decisions around today are really about trying to stabilise inflation expectations so that we can get future inflation towards the middle of the target band, and that's the primary motive. It's nothing to do with the exchange rate directly or joining the currency war.
Well, thanks very much indeed.